How can investors succeed in creating net zero portfolios whilst managing risk and sourcing strong forms of return? And in particular, what's the right time to engage, to be an activist, or to divest? My name's Hugh Van Steenis, and I'm joined by a terrific panel to debate these issues today. To my right, Sir Chris Hohn, founder of the Children's Investment Fund. To his right, Anne Richards, CEO of Fidelity International. Richard Manley, Head of Sustainable Investing at CPP Investments. And down the line from London, Dambisa Moyo, author, economist. So kicking off, I really wanted to start today thinking about what brought you to COP, and in particular, your own passion around the transition to net zero. So maybe, Chris, as you're sitting next to me, coming to you first, what's your journey and how do you frame the issues?
So I was always interested philanthropically in children in developing countries, and it became very clear that climate change is impacting their future through drought, malnutrition, environmental pollution, and forced migration. As an investor, it is clear that 35% of the total direct emissions are coming directly from companies. And the reality is that investors and companies are taking wildly insufficient action on climate change. The Paris Agreement requires that companies reduce emissions by 7% a year, net of any growth. But in reality, actual emissions for the corporate sector in aggregate are rising. So clearly, this focus on voluntary commitments is not working. And disclosure of emissions and climate action plans has to be mandatory, both for public and private companies. And I believe Greta Thunberg is absolutely right that there's a cynical game of greenwashing being played by companies and investors. They're pretending to act, but actually the statements and actions are either way too far in the future, like 2050 commitments to have any significance at all, and the capital investments being made are far too small. What we need is short-termism, 5-year science-based action plans, and there's really no time left for voluntary. And so if we have this mandatory disclosure that I'm calling for, it's not that I expect disclosure will lead to action, but it will give the information that that governments need to do the only thing that is going to change behavior significantly of companies, which is to regulate them and put carbon taxation.
Thanks, Chris. Anne, turning to you, how do you frame the issues as we come to the debate today?
Well, you asked first about personal motivation, and I think it's really interesting. Well, I love mountains. I've loved mountains since I was a child, walking up them, climbing them occasionally, skiing down them occasionally, and over the last 50 years, the mountains have been changing. They've been changing markedly, and I think in the earlier period, we thought it was just part of the natural cycle that the climate does go through. But it's become increasingly apparent over the most recent decades that we, as a species, are affecting things in addition to whatever the planet itself might be doing. And I think now it's crystal clear that this is the defining issue of our generation. It's our children, our grandchildren are going to hold us to account for it. And generations not yet born long after we're not here, are going to look back and judge us on how we reacted. So I think the personal motivation for me in this has been, as we have learned more, the time for excuses has passed. We need to take action. We need governments to take action. I completely agree with that. But in the absence, or perhaps because it is so difficult for governments around the world to get the collective agreement that they need, I do think there is a big responsibility on the corporate sector to play its part in doing what it can do to get us in the sphere of influence that it has to the best possible place that we can. And it's not easy. I'm sure we'll talk about some of the difficulties around about that. But I think we can't wait for government, because governments simply aren't acting quickly enough. We have to take responsibility on ourselves in every sector to play our part and do what we can.
Thank you. Richard, so how did you come to this?
An unconventional route. So early in my career, I was an oil and gas analyst, analyzing the oil and gas industry, until a letter from Kofi Annan arrived, posing the question, do good companies do better? I have to say, it wasn't a piece of research we ever expected to do. It wasn't an easy piece of research to do. But the conclusion at that point in time was that the oil industry was evolving. Those that competed with capital and engineering solutions were losing share. Those that had attained a more enlightened approach to their business model and sought to be partners in developing nations' scarce resources responsibly in terms of health and safety, community engagement, and environmental impact were winning more share. That catalyzed a change in my career to become an ESG analyst. And over the years of engaging with institutional investors all over the world, what I started to conclude was a few things. You don't need to take a norms-based approach to justify integration of climate and ESG into either corporate strategy or into the investment process. It's very, very clear that companies with boards that have embraced the reality of the world we are operating in, have identified the risks and seek to manage them, identified the opportunities and seek to capture them, will simply create greater value over the long term. And by extensions, investors seeking to do the same will deliver the same outcome, superior, sustainable returns over the very long term. So I eventually left investment banking. I concluded after a decade of working with investors on approaches to integrating ESG, it was appropriate to actually try and do what I was talking about. And I sit here today firmly of the view that climate is one of the biggest risks we have to confront in the decade ahead. But it is one that we can confront with human capital and with financial capital. We need to, I think, though, move beyond the compliance mindset. This is not a communication strategy. This is about a cultural evolution in the boardroom, in the executive suites, and in the capital markets. And if we get this right, we will decarbonize our economy. If we get this wrong, the impact over the very long term will be catastrophic.
Thank you, Richard. And Dambisa, I hope you can hear us well. Just turning to you, how you come to the climate finance issues.
Yes, well, thank you so much. I'm delighted to participate on this panel. I'm afraid that I'm not in the room with you, but I come to this really having been born and raised in Zambia, one of the poorest countries at the time I was born, and it continues to be so. In looking back on my career, now I'm over 50, so I look back on my life and I think a lot about what the massive constraint for Africans in particular, but for the emerging markets has been and continues to be. And ultimately, to my mind, it's about our inability to access education, healthcare, infrastructure, real opportunities to meaningfully impact our lives in a sustainable way. And really, I come to this because as much as I do believe that climate issues are urgent and are certainly require action, as my co-panelists have expressed here, I am deeply concerned that some of the efforts and perspective that's being approached will inadvertently, once again, prejudice and discriminate against people from my region of the world. So I do believe that we need to act. I do believe we need to act urgently, but I also think it's really imperative that we focus on long-term investment, and that doesn't mean not focusing and acting in the here and now. Of course, risk mitigation does matter, but we must absolutely think about the knock-on effects of the decisions that we make. Perhaps I'll just add one other line here, which is to say, I have the privilege of not only being someone who has been born and raised through my formative years through university in a country where energy crises are real things, not sort of theoretical constructs. But also I happen to serve on the board of one of the largest energy companies in the world, and I know what's going on in that space, and I'd be happy to share some of the governance initiatives in the energy sector broadly. I've served on the board of a large global bank, happy to offer some perspective there. And then finally, also serve on the board of an endowment of Oxford University. And so very familiar with the risks of defunding and some of the other campaigns that are, to my mind, very short-term in their pursuits, and therefore meaningfully put people like myself and who look like me at risk. And it's in that respect I bring that perspective to this conversation.
Thanks, Dambisa. Well, look, over the next 25 minutes, we'll pick on a couple of key topics in this area. So maybe, Anne, coming to you first. As you think about aligning portfolios to net zero, how are you constructing the portfolios? And in particular, what's the role of engagement in that?
So I think engagement is, has in terms of its centrality to very much help address some of the things that Dambisa has actually just mentioned. Engagement is a really important part of this, because if we simply divest the companies that don't meet some kind of standard that we set, we will not change their footprint. We've got to engage and try and think about how you create the delta, how you get a company from whatever its footprint is today to a better place, and to a better enough place that we can start to address the challenges that Chris was talking about, because they're big, they're real, and they're near term. So I think engagement is really important. Now, when we try and think about how we blend that into an overall portfolio, we really think about it in terms of layers. It's a mixture of top down and bottom up. In terms of the bottom up, we started by looking at the research that we did, so that every single company that we follow, we started with an ESG rating. We have since added to that a very explicit climate rating, which then allows us to aggregate any portfolio to see what the overall shape of that portfolio is. And then we're also able to, because we're beginning to build in scenario analysis and impact analysis, whether it's on inflation, whether it's on GDP, of that unintended climate risk that we see is there, bringing those together so that we build that portfolio, we can actually start to quantify and measure that risk of the unintended climate risk that is being borne. All of that brings pressure on the companies that we invest in to do better, because ultimately, if they don't do better, we can see that we will be forced ultimately down a divestment route, and we will do that over time. But we would prefer to start with really robust engagement to encourage them on this journey in the absence of stronger regulatory requirements for them to do that.
And so, Richard, as you think about engagement, what are the merits and what are the limits you find of engaging companies?
I find engagement to be a very, very powerful tool. And I think maybe just a few things to remind the audience in terms of the roles and responsibilities that accrue in the capital markets. The responsibility of the board is to the company, but its accountability is to the owners. And as owners, we don't have that many rights in the public equity markets. We have the right to appoint directors, to approve dividends, changes in bylaws, but not very much more. So we find it to be very helpful to actually articulate our expectations of boards. And our articulation of expectations with boards with respect to climate change is pretty concise. We expect the board, now 29 years after the UNFCCC was open for signatures, to have set up a clear oversight and governance framework for climate risk in the company, to have identified and quantified the climate risks and opportunities, to have integrated those insights into their strategy, operations, and public disclosures. And when we see that that's not taking place, we reasonably have to conclude that that board may not be acting in the best interests of our company. So the first thing I would say is to be clear in articulating expectations. The second, I think, is to demonstrate you know where you sit in the capital markets, and that is an owner with those rights. But then to be quite clear in engaging directly with issuers and setting out your expectations and seeking insights into when your expectations will be met. And if realistically they are not going to be met, to actually use the voting rights that we have in appointing directors. And importantly, when we vote against directors, communicating directly to the company, to that director, that we have withheld support for your reappointment because you are not meeting our expectations in terms of how proactive you are in managing climate risk. This year, in response to that, we saw during the core of the season, 17 of our portfolio companies commit to file a TCFD report by the next AGM to try and keep our support for their directors. And we've had a few more successes since the end of the core season. So I think it can be effective, but I sense there will be many in the audience also expecting us to be accelerating that momentum and that engagement going forward.
So, Chris, how are you shaping portfolios to net zero? And what's particularly, you obviously have you have strong heritage as an activist. What's your role of engagement versus activism here?
Yeah, so I absolutely agree with Anne that divestment doesn't solve anything because companies are always owned by somebody. And if everyone divests, they'll end up being owned by the least responsible investor. And so that, in other words, decarbonizing your portfolio through divestment doesn't do anything to decarbonize the real world. And yet that's what the vast preponderance of ESG funds are doing. Now, people talk about engagement, but the reality is most investors simply rubber stamp management targets and plans, however inadequate they are. And there's very limited voting against directors and engagement with other shareholders. Okay, if you want to force out a director, just voting against him, that doesn't necessarily do anything unless you actually get them out. And so you actually need to engage with other shareholders and say, we think this director's no good. Remove them. So very few, almost no mainstream investors file AGM resolutions. We file them, and we vote against management, but we find a lot of investors still vote against even simply disclosure, and because there is a reality that most investors in companies, in my view, don't want to see short-term profits reduced for the long-term benefits of decarbonization. So very recently, Rio Tinto announced a $5 billion in capex investment plan to decarbonize their portfolio. Investors reacted by selling the stock down 5% that day, expressing their disapproval. And so we're going to need, critically, independent grading of plans and plan performance. The time for talking about disclosure of emissions, we're long past that. Even disclosure of plans, not really interesting or relevant. It's only the performance in reducing your emissions. And investors, in my view, have to get a lot more aggressive in voting out boards where emissions just keep rising. That's and that's the acid test. Engage all you want. Companies can disclose all they want, but if the emissions keep rising, the shareholders aren't doing their job, the boards aren't doing their job, and you got to get them out. And so I want to see asset owners fire the asset managers where they're not being effective in seeing actual reduction in emissions and actual seeing the votes, and a lot more assertive approach is needed by the asset owners.
Dambisa, you obviously sat on both sides of the fence here. What do you see of the efficacy of engagement and what on the shortcomings?
So I think I'm a little bit more sanguine than perhaps what's been articulated. And once again, I'm not at all suggesting I'm a Luddite, and I'm not interested in more more progress and more action. I think that we are in a world where most people accept that that's necessary. In fact, as I intimated in my earlier remarks, I've not been in a single room, whether it's public policy, corporate boards, or endowments, where people aren't subscribed to a low carbon future. I do sympathize with the view that perhaps people expect more action in certain areas, but I think that there needs to be a recognition, and I think Anne made this point, that very often boards and the corporations that they serve are working in a policy vacuum. And that actually means that there's a lot of constraints, and I think Richard made this point, that are partly legal constraints of the fiduciary role, but also there are a number of constraints and pressures that we receive from shareholders that, although may be warranted, may not actually be easy to implement in a world where there's really no clarity on where public policies going on things like carbon pricing, or indeed there's still a lot of a patchwork around emission targets. And if I think a little bit about why it is that I'm sanguine, we've had pressure from institutional investors and society writ large that has been responded to. I'm thinking of Say on Pay. There was greater engagement and there were real alterations to compensation. Emissions, just to come back to the specific question of emissions, is difficult, again, not just because of public policy's absence, but also we know that, even if there are pledges and commitments to scope 1 and 2, scope 3 is incredibly tangled and difficult to execute on. And look, there are companies, GE is a great example, that are being quite avant-garde in this area. And I would just end where I started off earlier, which is to say, a lot of the pressure that boards and board members feel is that we want to make sure that we are implementing policies that are sustainable and that aren't prejudicing some of the broader policy questions that we can't lose sight of around access to goods and services across the world, but also to be sensitive to the fact that this is really about living standards and also recognizing that this is not just a switch off or on, but this is a transition, and therefore it won't be linear. I think that will be very choppy as we go through this process, but there needs to be a little bit more temerity and humility, I would say, in addressing this very complex challenge that the world is facing today.
Thanks, Dambisa. So a key theme of the panel so far has been about holding boards accountable. So Richard, do you have enough data? Do you have the right tools to be able to hold the teams accountable? And what do you need?
Okay. No. So it's interesting, as we footprint the carbon intensity of the portfolio, unfortunately, and look, we have a portfolio that spans an awful lot of assets across the globe. Just 30% of the information we have today for our carbon footprint is coming directly from the issuer. About 7% we're able to source from market data vendors. 45% is effectively using proxies because we have to effectively have a placeholder for the information. We use adjacent peers. The rest is really coming from government. And I think just given how far we are through the need to transition the economy, being in a position today where for that share of our portfolio, the issuers are still not even reporting baseline emissions, let alone the integrity of how they will deliver their targets, I think is indicative of the magnitude of progress we need to make in the years ahead in terms of disclosure. Belying that, though, I will say that where we are today, and I know Chris has touched on reconciling short-term with long-term, telling us that we're going to be net zero by 2050 is analogous to me telling you I'm going to run a 1 hour 45 marathon. Okay? There is only one question you will have for me, and that's, Richard, that's really great, but what's your personal best? I think we need a mechanism to corporates to be able to articulate their personal best. And we have published a paper recently looking at whether there are actually existing accounting standards that we could repurpose to actually have corporates, when articulating their transition ambitions, both short and medium term, go through the process of articulating to the users of their financial statements what percentage of their decarbonisation will they address through efficiency, through greening of their power supplies, through investments economic now. And I would view that as their effectively short-term or proven abatement capacity. And then, and I think Dambisa's touched on this, we do have a difficult interplay between consumer behavior, regulation, and technology costs. And if we try and solve for all of those in the same equation, we will tie ourselves up in knots. We propose that they should be kept flat, and we simply ask issuers to report how much more they could abate at $75 a ton carbon price, and then at 150, with a view that over the medium term we will get there, and that is therefore highly likely abatement potential. The last bit, the bit that's uneconomic at $150, is going to require some harder work. It may need to be shut down, it may need to be offset, or alternatively, if companies are genuinely hopeful that they have technology they will be able to deploy, then I think it's fair to leave the residual opportunity to articulate that. But if every company was able to tell us what they have in hand that they can abate now, what they expect to be able to abate over the medium term, based on existing technologies that are just out of the money. I think the transformation we will have in visibility will be considerable, but importantly, it will allow us to reframe the debate, not between how are you getting there, but now that you've articulated how you'll get there, when will you deliver it?
And would agree, disagree?
Look, I think I agree with an awful lot of what Richard just said. I mean, I think, and I think the point about the carbon emissions disclosure and getting clear pinpoint accuracy on how you bring that down. I mean, I think this is absolutely desirable. I do think we've got to think about the political reality that Dambisa touched on at the start, which is how you create the transition roadmap that doesn't end up with second order effects that knock this off the political agenda. The reality of the sort of just transition is that the people hit in the short term by the higher costs that come from decarbonisation, who are often the least privileged in society, and the people hit by the unintended effects of the sort of climate change or the unabated effects of climate change are also amongst the least privileged in society globally. But they're not necessarily the same, and they don't necessarily vote to the same pattern. So we've got to find a way of, I think, bringing the consumer side, the demand side, the wider population side with us on the practical things that it means for them. And if there are higher costs going to be loaded onto individuals in society, which inevitably there must be, we've got to find a way of spreading that in a way that makes it affordable. Otherwise, it will be deflected politically. And I think it's really tough but we see this, it's a little, Lord, make me good, but not yet, which is really sort of a little bit what you were saying. And I think we're seeing a lot of that. And I think we've got to find a way of bringing that political reality and expediency into the debate. Otherwise, we'll get deflected.
Chris, do you have enough data to hold management to account?
No, because most companies still aren't reporting their emissions. Almost no country is making it mandatory. There's no mandatory plans except in Spain. Spain was the first country in the world to require these mandatory 5-year action plans. So we can't just talk about disclosure of emissions. Yeah, it's just we can't even get that. So but beyond disclosure is action, and right, companies are going to need to advocate for regulation and carbon taxation in order to get a level playing field to make these investments, and the governments can rebate carbon taxes through direct cash transfers to people to mitigate these extra costs, which are going to occur. And we just got to get more sophisticated. The plans that have to be made mandatory must show 5-year plans every year, and when they're not reducing emissions down over those 5 years in line with Paris, 7% a year, they've got to explain why they're not doing it. And we've got to tie executive compensation to it, which people don't do. And it's the plans have got to have the capex and be audited. That's the other key point. How do we know if any of these plans or emissions disclosure are real if they're not audited? So one thing we're doing in our foundation is funding a rating agency in order to grade these plans and plan performance and basically call out the greenwash.
Dambisa, what's your perspective on this?
Well, I actually agree with everything that has been said, including Chris's last remarks. I think the thing that gets missed a lot in these conversations is that we do tend to take a very much a frame, which to my mind tends to be very risk mitigation focused. So let's try and keep the downside emissions, sort of trying to curb fossil fuel carbon usage. And I think there's just not enough discussion around the upside opportunities, the fact that we shouldn't be losing sight of that. The pie has to continue to grow. There are going to be 9.8 billion of us on the planet, 10 billion by 2050. Already before even, really fever pitch here, we already have over 1 billion people in the world who don't have access to energy in a sustainable and cost-effective way. It's happening already, and we haven't, got through this next decade. So I think maybe just in terms of adding on to what has been said around disclosures and the fact that that emissions is just one thing. And I should say, by the way, a lot of companies, certainly the ones that I'm involved with, have already attached climate goals to compensation for management. So I do think that there's progress being made there. But I would love to just make sure we don't lose sight in our fevered approach to dealing with risk, that we stop thinking about the fact that this is ultimately a very complex technological problem that the world faces, as much as people love to reach for policy as a solution. And I want to make sure that policy doesn't reach so far that it starts to really kill off any innovation that's going to be required to solve this in the long term.
That makes sense. So in the last few minutes we have remaining, I would think obviously tomorrow is Finance Day here at COP, and you've all argued that there's an important role for extra data and also for regulation. So maybe if I just start thinking about what do you want to see from central banks or regulators to help work with you? Maybe Chris, you've recently written a letter. Maybe if I start with you and then come around, and I'll keep it reasonably brief.
The banks are critical. They have a critical role because they finance the economies, but they don't even collect the emissions data of their borrowers. And so how can they price the risk of carbon emissions so they've got to be forced by the central banks who regulate them to collect the emissions of their borrowers and have 5-year decarbonization plans for their loan portfolios. And in order to incentivize, and central banks need to put more capital, force more capital, higher capital ratios against dirty companies than clean companies, reflecting the higher risk. And so that's what I'm calling for.
And you wrote an op-ed on this. Maybe share with your perspective.
Well, look, I think, stress testing, scenario analysis, really important policy tools to start with. I think central banks have more tools that they can apply. A green QE would be an example of that. Actually using their power with what they do with the central bank balance sheet would be one way of shifting the relative cost of capital for green versus non-green. And I think thinking about the capital rules, if you believe that carrots are better than sticks, well, rather than adding capital loading for non-green lending, maybe giving capital adjustments in a positive way to encourage more green lending. Those are tools that central banks have, and I'm sure there are a bunch of other things that can be looked at as well. But given the centrality of central bank policy and regulation to the whole financial system, the power that comes with that, I think, is immense. So I think there's a lot of tools that have to be used with care, but that are powerful that we have yet to apply.
And Dambisa, I'm conscious of time, but maybe in a couple of sentences, anything you'd like to add?
Yes, 3 very quick things which I published in the Policy Exchange document on Friday. Carbon pricing, we need more visibility there, and I think governments can act. Principles versus rules. We're going to solve this only with technology, I believe, and so we need a legal and regulatory environment that encourages investment, not just focused on the downside. And then governance. We talked about this. We don't even hear much about transition assets. The traditional bad banks discussion we had with the banks. There might be an opportunity to think about transition assets in that space. So those are the things I would be looking for.
Fantastic. Well, look, Dambisa and Richard, Chris, thank you very much indeed. We could have carried on for another hour at least, but I think I came away with a very clear review from each of you that we need to hold boards accountable, that engagement is critical, that divestment is just paper decarbonisation, and therefore we need to have the data to hold, data and analysis and tools to hold boards accountable. With that, thank you very much indeed once again.